Like other companies, banks are profit-making enterprises. However, most of their profits come from taking risks. If we understand where the profits come from, we might understand the risks. As they say in the detective dramas, follow the money. My name is Philip Winkle. I've been working in the banking industry for over 40 years, mainly in the credit and risk areas. I've spent a lifetime making loans and recovering them, sometimes the same loans. Over the years, I've found that many people measuring and modelling risk in banks are focused on a small area of the business and can benefit from a broader understanding. In the next 30 minutes or so, I will explain the most common ways banks make profits and how this usually requires them to take risks. This is the nature of banking. Global Credit Data is a non-profit association owned and run by banks. Our motto is by banks for banks. Global Credit Data collects bank loan data, especially rating grades and defaults, to help banks better understand the risk of lending and credit. Anyone looking at the annual report or the website of a bank will see a bewildering range of different products, from savings to housing loans, from overdrafts to project finance, from credit cards to foreign exchange services. Each one of these products is based on one or more of the activities in the list below. Every activity gives rise to one or more risks. The banks measure, manage, and mitigate all of these risks. Many of the activities are related to lending and deposit taking, but not all. So we break down the lending activity into the 4 risks that this entails in order to understand the risks more completely. Banks accept that they take risk, and their boards normally set up a risk appetite framework to limit the amount and type of risks that they take. So let's take a look at each activity in detail and the common products that they support and the problems that these risk-taking activities have caused banks in the past. The first 4 activities we'll look at are based on deposits and loans, traditionally the core activity of a bank. Banks group the deposits from lots of savers and companies and lend this money out to borrowers. So far, so simple. In this example, the bank is using savings deposits to fund a company mortgage loan. The bank pays the savers very little, often zero, for keeping their money in a demand account or a convenience account where they can withdraw it at any time. Now, the bank knows that normally the depositors who take their money out on any one day will be balanced by other depositors putting new money in on that day. So overall, there's no problem for the bank. So in this example, the bank makes a 5-year loan to the borrower because the borrower needs to know that he can take his time to pay the money back. The bank is able to charge the borrower a higher rate just because the loan is committed for that 5-year term. The bank is said to be transforming overnight money that it takes in as deposits into long maturity money, and it earns a nice margin from this. In this case, we're saying it's a 4% margin. Now, the risk that the bank is really taking here is liquidity risk. If for any reason too many depositors want their money back today, then the bank will run out of money because its loans are not liquid. Liquidity problems sometimes called a run on the bank, and they are the usual cause of a bank collapse. There may be other things that happen before this, but normally that is what precipitates a bank collapse. Of course, in this example, the bank is also taking a credit risk on the borrower and may have a problem if the borrower cannot repay, but we'll come to that later. The example of a problem occurring here is Northern Rock Bank in UK in 2009, where they borrowed short-term money from the interbank market to fund their long-term mortgage loans, with dire consequences when the market found out. The second element of maturity transformation involves what the banks call riding the yield curve. So this example is very similar. A bank groups together lots of short-term deposits and then places them in a long-term asset. But this time the bank is able to avoid the liquidity trap, as instead of lending the money to a borrower where it can't get at it quickly, the bank invests the money in super safe, super liquid US government bonds, so no liquidity risk this time. The bank is still able to earn a nice margin because it is paying the depositors the low interest rate from the short end of the yield curve, but receiving the much higher interest coupon from the long end of the yield curve. This would be fine if the bank was able to hold the treasury bonds to maturity, provided it did not have to pay its depositors an overnight rate above 3%, then it could still make money. But the problem arises when either the short-term rates rise or if the depositors want their money back. If the long-term rates have also risen, then the bank can sell the bonds, but they will suffer a huge loss, which might even put them out of business. This was exactly what happened to Silicon Valley Bank in 2023. In this next activity, the bank is still taking deposits and making loans, but this time we focus on the credit margin the bank is able to extract. The bank is a strong credit risk and so is able to pay depositors a low interest margin above the risk-free rate. But the borrower is a much higher risk and therefore must pay the bank a higher interest rate. The difference is called the margin or spread. The margin the bank charges reflects both the borrower's probability of default and the loss given default of the loan deal, including recognizing any collateral. Now the bank is being paid for the risk of the borrower defaulting and the risk that after a default there will not be enough money left to repay the loan completely, the recovery risk. The risk of having a too risky lending book, including misvaluing collateral, often results in the public, other banks and depositors losing faith in the bank, which leads to a run on deposits and a closure of the bank. The Icelandic banks aggressively grew their loan books in the mid-2000s, especially real estate-based lending in countries outside their home market, where they didn't really understand the risk. The result was catastrophic, not just for those banks, but also for their country, which was forced to pay back many depositors. The final item we will discuss about the lending book is the topic of diversification, which is in fact not a risk at all, but actually meant to be a mitigation of risk. In the previous example, the bank is able to charge each borrower a credit margin appropriate to its credit rating and loan deal terms. So we follow that here. However, here the bank can pool all these loans either in its own balance sheet or by selling part or all of the portfolio or putting the loans into investable special purpose companies. The bank can make money on selling the loans or selling participations in the loans or just funding itself at a lower rate based on the perception that it has a lower risk because it has a well-diversified portfolio. Now, when viewed as a group, the credit risk of a whole bunch of loans is normally much lower than the average risk of each deal in the group due to diversification, with the assumption that there is a low or less than 1 correlation between the risk of default in the group. If the group of loans has diverse borrowers from different countries, regions, industries, sizes, collateral types, then it can be viewed as lower risk due to diversification. This is because the negative economic events which could impact one borrower or one collateral might not impact another borrower or another collateral in the group. Assumptions about correlations may not hold, however, as happened in the subprime case when packages of subprime loans suffered huge problems, with sometimes 30% or more of the loans falling into default. It was not helped by the fact that often the loans had similar houses as collaterals, perhaps even in the same subdivision. This was not the only cause of the subprime crisis, which brought down Lehman Brothers in 2009, but it was an important component. Diversification within a loan portfolio is also reduced when it contains one or more very large exposures. In theory, the fluffy bed of small loans is meant to cushion the effect of the cannonball of a single large exposure. Well, of course, that depends on the size of the cannonball. Now we finally get to move on from lending and deposits into the world of trade and payments. Banks grease the wheels of international trade by handling most of the payments. Even credit card payments eventually find their way back into the banking systems where there is money to be made. Banks can charge fees for payments and good margins when the payment involves a conversion to a foreign currency. Aside from the credit card fees and the interest on unpaid credit card accounts, banks are able to charge the merchant who sells the goods and services. This varies, but can be 2 or 3% of the sale price. But this activity, of course, carries risks. Every payment a bank makes on behalf of a customer exposes the bank to the counterparty risk of another bank failing. Even the merchant credit card terminals have a risk, as the bank often pays the merchant before getting the money back from the credit card holder's bank. Foreign exchange settlements often involve correspondent banks and may require taking settlement risks on multiple banks. Finally, of course, there is the risk of fat finger error, where a bank may automatically or through human error send the wrong amount of payment to the right recipient or send the right amount to the wrong recipient. This is classed as operational risk. In addition to the simple payments above, a bank will also engage in more complex documentation-based activities called trade finance, which has its own special risks and rewards. Now we enter the trading room of the bank and the world of market risk. Banks need to stand in the market with other banks to trade bonds and currencies, commodities, and all manner of financial instruments in order to support their customers. So as an example, a bank might create an exchange-traded fund to sell to its customers, and then it will need to buy and sell this so-called ETF, as well as being active in the market for instruments that support this. The same goes for equity underwriting, where a bank needs to make sure there is an active equity market in the shares in order to make sure an IPO or a share issue is successful. Now, sometimes banks receive fees for market making, but usually they make money from the bid-offer spread on the instrument. So if you ask a bank to sell you euro for your US dollars, then you'll probably receive around 92 euro cents for each dollar. But if you go to sell them back the other way on the same day to the same bank, then you'll have to pay 94 euro cents to buy the dollars back. That 2 cents is the profit of the bank. Of course, in the wholesale markets, the spreads are much, much finer. They may be 0.01% or less, but the principle is the same. There are so many instruments being traded in the markets that there are bound to be little corners of low liquidity from time to time, where a bank can make money by being the only buyer and then covering its position in another market or another similar instrument. This is called arbitrage. One of the more common ways which banks used to make money from the market activities was by using the information gained from customer transactions to do some trading on their own behalf. For example, a customer might tell the bank that it is receiving a large amount of New Zealand dollars in the next week and ask the bank to recommend a good time to sell. The bank's trader would then know that a big order to sell New Zealand dollars would be coming into the market, and they could set up a position to profit from when that price would likely fall. These activities are nowadays heavily restricted by the European rules called MiFID and by the US best execution obligations, with best practice being to place an information firewall between customer trading and proprietary trading. However, it is never possible to fully balance buying and selling in the markets at exactly the same time, and therefore banks always have some sort of risk that the markets may move while they hold a position. Even with a completely balanced book, a bank is open to the risk that other banks and customers with which it has dealt will get into difficulties and therefore could not pay on their contracts. This is called counterparty risk. It's not just a problem that other banks might not be able to cover their losses. Every settlement has a risk. In a simple spot FX deal, the bank can demand that their customer pay up the dollar amount of their settlement into an account at the bank before they pay out the euro to a correspondent bank. But in the case of a bank-to-bank FX settlement, the bank has to pay first and hope the other bank is paying at the same time. This can get very tricky when there are rumours about a bank getting into trouble. Do you believe the rumours and not pay your settlement, or do you fulfil your legal obligation and pay, risking becoming a major creditor of a failed bank? Finally, with big sums of money flying around, the consequences of an error can be catastrophic. The error could come from human mistakes or from a system error. It really doesn't matter. The result is just as bad. Most of the time, a wrong payment can be recovered, but if a bank accidentally sends money to a company who spends it, then the bank has suddenly become an unintentional lender. The example of the Archegos Capital prime brokerage loss for many banks was a good example of incorrect market and counterparty risk assessment by these banks. They each thought that they were the only bank supporting their customer in buying up a big position in a listed company. Of course, as soon as the market found out that many banks were supporting this position, they were all forced to sell out at the same time, pushing the market in the wrong direction and creating enormous losses for the banks. Banks often take some sort of deliberate market positions in order to make a profit from movements in the market. They may have a specific desk in their trading room which takes these risks, staffed by experienced traders who believe that they can read the markets. They may also run open positions hoping for shares to go up, or they may short the market hoping the shares go down. Either way, the traders make money not only on the market movement, but also on the bid-offer spread they are able to make as a bank. Banks running prop trading, as it's called, are open to all of the risks which they take in their normal market-making activities that we just looked at. However, they also open themselves to the risk of a rogue trader who takes more risk than the bank thinks they're taking and can bring down the entire bank. Nick Leeson was trading for Baring Brothers in Singapore in 1994, and he fraudulently pretended that his big open positions on the Nikkei stock market were covered by offsetting trades, which did not exist. He caused the entire bank to fail. Now these days, banks have tightened reporting and verification rules so that rogue trader events are smaller and less common, but they can still occur. Also, regulators have limited the bank's ability to run prop trading as it increases systemic risk, that is, the risk of one bank infecting the entire system. Rules such as the Volcker rule in the US restrict this activity. Investment management is generally regarded as a lower risk activity for banks. Banks look after the money of other people, who are often high net worth individuals, and in theory, these investors take all the risk. Banks can create special products to help investors take the risk they want, for example, exchange-traded funds or mutual funds. Now, in return, banks receive fees for the transactions as well as an annual fee of a percentage of the total amount they're looking after. There is also lots of trading activities on shares and bonds and funds and FX, which a bank can profit from by taking the usual buy-sell spread that we talked about previously. So what could go wrong? Well, plenty. Investment management relies heavily on reputation and trust. Too many bad investments will cause the customers to take their money elsewhere, resulting in operating losses. There are also many rules around acting in the best interest of the customer, which may take the bank into litigation if the customer loses money. And of course, there's always the possibility of employee fraud and operational errors, particularly when you're looking after other people's money, where they might not be checking what you are doing with it every day. Credit Suisse was taken over by its rival UBS in 2023. as a result of too much reputation damage, including its involvement with Greensill Capital and Archegos, which incurred significant losses for Credit Suisse's customers, not directly for Credit Suisse. Every known risk which a bank takes is mitigated to some degree. Liquidity is separately modelled and stress tested, with banks running run-on-the-bank type simulations. Ultimately, the governments are often forced to step in and recapitalise banks, which they don't like. So many governments have specifically guaranteed the retail deposits of the banks operating in their country, up to a point. So they really do press banking regulators hard to make sure that they, as a government, never have to pay out on these guarantees. Global banking regulators work together to limit the risk of bank defaults. And the peak regulator body is called the Basel Committee of Banking Supervision, or BCBS. BCBS has set up the so-called Basel rules, requiring banks to hold capital appropriate to their risks, in the hope that a bank will default only once in 1,000 years. Capital is calculated and held to cover most of the measured risks, that's credit, market and operational, using a common measurement called risk-weighted assets, or RWA. Now, credit risks comprise around 70% of many banks' risk-weighted assets and capital, with operational and market risk making up the rest. All of the mitigants that we've listed here and all of the supervision relies on the banks themselves having enough resources and the will to correctly identify and measure the risks, as well as setting in place policies and limits to make sure that the risks don't get out of hand. Hopefully, this little video has given you some sort of idea about the risks that banks take and some insight into your potential role, if you work in a bank in the risk area, your potential role in managing or mitigating that risk, or building credit risk models, or calculating the risk. If you want more information on credit risk data pooling and credit risk methodology pooling by banks, then contact us at Global Credit Data. Thank you.